Philip Carter was the CEO of Carter & Carter, a training and services empire with contracts across the globe. It was worth more than £500 million, that's £1 billion Singapore dollars approximately. And that was worth that at its April 2007 peak, just 1 month before Carter died, and he was aged 44. Carter had watched his favourite soccer team, Chelsea, play Liverpool at Anfield. He and his son had just left John Lennon's airport in Liverpool in a helicopter. They never made it home. And in the immediate wake of the news of Carter's death, Carter & Carter's shares fell by 11%. But prospects for the company still remained bright. However, there were 3 profit warnings issued in quick succession throughout the summer. And by October, trading in the shares had been stopped. In December 2007, the London Times wrote that Carter & Carter were in discussions with their bankers because it wasn't making enough money to service its 131 million debts. The death of Philip Carter marked the sharp decline of the company. And on March the 11th, 2008, just 10 months after Carter died, the company was placed in administration. Carter & Carter failed to negotiate a bailout with the banks despite months of talks. The decision for the banks to back away just came out of the blue. It sounds callous, cold, calculating, but it's not for us to judge because we simply don't know the facts. But on March the 21st, 2008, it was announced all investors' shares were worthless. Fidelity International, the global investment fund with thousands of retail investors, was the second largest investor with a 12% stake, which fell from 63 million UK pounds to nothing in under a year. A 100% loss. I told this story at an MDRT day earlier in the year, and a member approached me. He told me the story had moved him because one of his clients had invested a great deal of his pension fund in Carter & Carter and had sadly lost it all. This story demonstrates what a key man Philip Carter was to his company. And the loss of confidence expressed so quickly after his death could perhaps have been stalled with a rapid injection of cash, a key man policy. It highlights why corporate debt must be covered with loan protection insurance, because it will allow a company to run its own affairs and not be at the whim of the banks. And it shows why we need to look at the bigger picture and create an holistic plan for our business clients as well. We cannot allow our clients to tell us their business is their retirement plan. Because if failure can be as swift with a £500 million company, just think of the consequences for the many businesses that we advise now. What else can disrupt our financial planning in retirement?